Hello. So now it's Thursday, July 17th, and I finally got to talk about the big, beautiful bill which became a law. Now we have big, beautiful bill act. Well, okay, this is all good, but uh, the sad story is that yes, the low taxes are extended, and there are a lot of bonuses, deductions, and all the other nice stuff, which I'm not going to focus on the details. The details we sent out to our clients in the email. So you can download the PDF file there, or we have a link in the description which you can follow and go through the book with the descriptions, with the details of the Big Beautiful Bill Act. However, what's in it for us? Yes, we did get the main point is the low taxes got extended for additional 4 years. The standard deduction is a little bit higher, but most importantly, the limit on sole taxes, state and local income taxes, got increased to $40,000, which means for many of our clients that now they might be able to itemize deductions again, because we all know in California, state income taxes are pretty high and state local taxes, property taxes are pretty high as well. So, taking into account that we don't have to worry about the alternative minimum tax, we are in good shape, right? So, all these changes are said to be permanent, but I cannot say it with straight face permanent in tax law. We know that nothing is permanent. So how do we use these old and new tax benefits to our benefit? Because what the purpose, what the point about taxes if we cannot use them to our benefit, if we cannot take advantage of the current law, right? Well, for the past few years, we've been talking to our clients about converting their tax deferred accounts to tax free world. And now some people have a question. Well, these new low taxes are permanent. Do we still need to worry about conversions? And in our professional opinion, the answer is absolutely, certainly, definitely yes, yes, yes. You should take advantage of these 4 years to plan your next 30 or 40 years in retirement, and let me explain why. First, like I said before, permanent does not mean permanent. Nothing in tax law is permanent. All it means that we've got an extension. Under current administration, they are going to keep taxes low. So, tax law is written in pencil. Congress has a huge giant eraser. They can change the taxes every 2 to 4 years, whatever, whenever they decide to do so. Well, and well, the only permanent thing about tax law is taxes always change. Well, four ways how taxes can increase in the future. First, the tax brackets can be increased, can go higher, right? Income, right now tax brackets are really low. So they're at the historical lowest point. Income applied to each tax bracket can change. Let's say right now you're on $300,000 earners, probably are in 24% tax bracket. They can change it. They can lower that threshold. They can drop it. They can drop it to $100,000. And now, boom, all of a sudden, you're in 24% tax bracket. So the income applicable to each bracket can change. Oh, the highest bracket right now is 37%. They can just change the income applicable to that bracket. They could say, okay, if you earn over $250,000, boom, you're in 37% tax bracket. So that can change as well. And this has been changing all the time. Deductions, tax deductions, oh my God, they can be reduced. Remember, SOLP deductions, state and local income tax, was unlimited. The only thing we had to worry about is about alternative minimum tax, which they could trigger. But now, then they changed it. They reduced it. They capped it at $10,000, which hurt a lot of people in states like California. So deductions can be reduced, deductions can be capped, phased out, or taken away altogether. And also, the additional taxes and fees and surcharges can be imposed. For example, our favorite lady Irma. Remember the Irma, it's the additional surcharge for higher income earners on Medicare Part B and Part D. They increase IRMA on average 7% every year. This is not a tax. This is income related monthly adjustment amount. But I'm sorry, when it's an adjustment which is related to income, what is it if it's not a tax? We have a video about IRMA. You can watch it there. And hey, so why do we think taxes still will be going up? Well, we are still in debt. Our government is still in debt. The deficit is over $36 trillion. So now with these 4 years of extension of super low tax brackets, the debt will keep growing. The interest on this debt will keep growing because it's very difficult to reduce interest rates right now, right? So we all hear the news, right? So the interest will keep growing. The interest, just the expense just to service the national debt is pushing $1 trillion a year. We take just barely enough revenues to cover four basic obligations for our government, which is Social Security, Medicare, Medicaid, and interest on federal debt. So the taxes will have to go up in the future. Good news is we have at least 4 more years to take advantage of the current situation. We can leverage our current tax laws, which are right now today, to get ready for the tax laws in the future. That's why we think that absolutely right now you need to focus on moving your tax deferred money. Why? Because they're tax deferred, which means the taxes will be due on this money. It will be payable in the future, and the government will decide at what rate it's going to be taxed. So right now we know the rates are low. Let's move them from tax deferred world into tax free world. So when you are in retirement, well, right now we have 4 years, right now in these low tax brackets. But then in retirement, you will be living there maybe 20, 30, 40 years. Let's get ready. So in the future, you don't have to worry about taxes. You don't have to worry about changes the Congress is going to impose. You don't have to